This is the Angel Connect podcast series, episode number 17. What are the 7 key points or even criteria for investment? An interview with Ed Fikse. In this episode, Hall Martin, who is the director of the Texas Entrepreneur Networks and Austin Angel Networks, discusses the 7 points or criteria for investment. And these are topics ranging all the way from experience and leadership, even to capitalization. That is, how much of a percentage of the company would you own? You'll see that these are interesting and take into account years of experience as well as insights. So let's listen to this particular interview conducted over the Skype network with Hall Martin interviewing Ed Fikse. Let's listen in.
Well, welcome to the Angel Connect podcast. We're here today with Ed Fikse of the board of the Baylor Angel Network. Ed, thank you for joining us. Glad you could be here.
Oh, happy to be a part of your program and your podcast here.
Well, thank you, Ed. You've been a long-time angel investor. I've seen quite a few deals coming through, and in this one, we want to talk about what does an angel look for in a deal before you invest? What kind of criteria is out there? And that varies from one angel to the next, but Ed, tell us about your criteria and what you look for.
Yeah, Hall, again, I think what your first statement is absolutely what I was going to lead off with, which is that, these are the criteria that, I've come up with that we're going to talk about, this morning. But I think it's important for every individual to, come up with their own criteria. But at some point, I think some of the things that I'm going to mention here will fit into everybody's strategy one way or the other. I don't view what I'm saying here as rocket science, but I think when you sit down and start putting everything down on paper, there's a lot of just common sense, around the criteria that came into focus for me. So let me just start off with, and I've identified 7 points. I'll just try to list the 7, and then we'll just spend a few seconds talking about each one. Number 1, I put down the CEO and management team. To me, this is probably clearly my number 1. It's about their experience, their knowledge base. Have they been there? Have they done that? The other thing I look for is, if the CEO is an engineer, well, does he have a sales COO, or does he have somebody, as part of his management team that can bring that discipline to it, or vice versa? If you've got a sales COO, does he have someone or some individual that's in the back room that's the engineer that's really doing all of the thought work, the leadership? What about the finance aspect of it? I think that is so important, especially when you're looking at an organization that's young and what you have to understand. They're going to go through multiple phases. Okay, they're going to start off with an idea. It's going to lead to, starting off in revenue. Then they're going through a growth capital phase, growth in the marketplace. They're building networks. And so it is so important that you've got, in my opinion, somebody that has been there, done that can provide the leadership going through this. So that I put down as my number 1 item, Hall.
Well, that sounds great. Yeah, of course, management team is always an important factor, and experience is important, but if you've got 2 deals there and one has a 10-year experienced management team and the other has a 10-year experienced management team and you can only pick one, well, how do you decide between the 2? What's the next level? Next level
of points. And for me, the next thing I look at is, do I understand the market? And, it's just like, I guess you could say investing in the stock market, probably not a good analogy these days, given what we see in the market going up and down, but still, I like to invest in stocks that I understand the business, that they're in and, what they're about, the market that they're trying to go to. So to me, that's a very important aspect. What industry segment are they in? Do I understand their offering? Who are they selling to? And if I don't understand, do I have a trusted partner or an individual, that I can collaborate with? In my case, I've got a former partner at Accenture. He and I were partners for 20 years together. We're both part of the Baylor Angel Network, and we'll bounce ideas off of each other. I've got an oil and gas background. He's got a healthcare background. And, healthcare is something that is such a significant aspect of the economy and new ideas, and we're always seeing a lot of those opportunities. But I just don't have the background and depth of knowledge to be able to, clearly vet them. And so I will rely on Mike a lot. And by the way, that's one of the things that I also, would say about the Baylor Angel Network. We've got a lot of alums or individuals in that room that have a vast amount of knowledge and experience in the markets that some of these entrepreneurs are presenting. And I just can't tell you how valuable it is to have that knowledge in the room. And so that's my second criteria that I look at if we got two deals. Do I understand the market? And if I don't, do I have a partner in the room that understands the market to get me comfortable with, the investment? So that was my second criteria, Hall.
Well, that sounds great. The market is, can vary quite a bit out there, and having people to work with really helps cover the bases. You understand oil and gas, but what other markets do you know about?
Yeah, I understand oil and gas, again, with the base of Accenture that I was with for, 34 years. Obviously, Accenture is a technology-based consulting firm. And so we do a lot of work associated with people, process, technology. And so I'm very comfortable listening to companies talk about software, talk about offerings, markets. We start talking about software as a service, some of those aspects. Those are things, those are offerings that I understand. I also know that when we start talking about software as a service, when you look at that market today, it's very hot. It has a higher multiple than standard software offerings. And so, it helps to, know the marketplace, what people are doing, and it just gives us it gives me a lot of comfort, when I can, talk in that space and talk with the CEO, COO, about what it is that they're doing, who are their target clients, where are they going, and so that just gives me a comfort, with the investment that I'm looking at making.
Right. Well, that sounds good. What's your number three?
Well, number three is, the business model, which is, okay, I like the management team. Let's just say that it's in space that I like, and let's just say it's an oil and gas. But now, how do you plan to make money? And this, I think, is a significant point as it relates to you can go out there in the marketplace and have a good offering, but you've got to figure out where's the business model and how do you plan to capture, value. And if it's a consumer products company, it can be about, okay, let's talk about your price. How are you going to price your kale chips, if you will, or how are you going to price your new tea that's out there. But then also, it's not only about pricing it, but it's also about, well, how about your margin? What about your manufacturing cost? How are you going to leverage, your distribution side of it? And it all comes down to margin. Because if you've got a great product, but you've got no margins, it gets hard to really get your return of capital, to see the value. If it's technology, again, I mentioned if it's software, as a service, which is, SaaS offerings today. People talk about SaaS. It's just a big deal. Well, how do you plan to build your network? Because SaaS works, but it works only when you have a high volume of users that are using the product. So how do you plan to get this product out in the marketplace? What's your marketing ideas? How are you going? Are you leveraging channels? So it's all about, the model. It all gets back to how you're driving value, because value is what you've got to drive to get the returns to the investors and also to make this an attractive, company for the future.
Well, that sounds great. It's so important to know how you're going to make money and have a real good sense of what things really cost and what things really are versus what things might be forecasted as well. So that's a good point. What's your number four?
Well, then it gets down to, and I think 3 and 4, actually 2 and 3, which is understanding the market. 3 is the business model, and then 4 is how big is the market. Okay, so now you've got a great offering. You like the business model, but how big is the market that you can go after? If it's just if it's a great offering, but it's targeted at specific individuals, let's say, or specific niches, that you've got to have even if you get a dominant share of that market. But if it's not big enough, Hall, then you run into the whole growth aspect. Then you run into the whole growth issue. In other words, you can get to a high level of growth. You get to a certain level, but then it's going to get very hard to get to that next growth level because you just don't have the market there. And I think you see that a lot with companies that just kind of stall at a certain point. They kind of get a high growth, they level off, then they start saying, well, what's next? And at this point in time, it's hard to see the value going forward. And in my personal, what I've seen in the past, these are the companies that get absorbed into other companies, but the value that they get for their company really is, they don't get as much as what they thought they'd get, and the reason is because they can't show a projected growth in the future. And so, how big is the market? Let's face it, when you look at companies that get bought out today, a lot of these high-priced companies, or the companies that get bought out with a high price, it's not because of what they've done in the past, but it's because of what they see as the future potential of growth. And that's where they drive the value, into their offering price.
So what do you think about emerging markets where the market is small but is growing very fast? How do you treat that in that case?
Well, to me, I like emerging markets, but Hall, I think it's also a case of where, are you familiar? Now you get into the whole aspect of, are you set up in that emerging marketplace to be successful? Because you have to deal with the culture issues, you have to deal with the laws, the regulations, and all that. And to me, if you're going to get into the emerging marketplace and deal with, that growth, it is so important to have a team on the ground there that can actually help capture, that marketplace. I think far too many people, think that, well, the way we can take this product and really grow it into this emerging market is we're going to wind up, we'll go over there, we'll meet some people, and away we go. And I just think that you've really got to have a plan that talks about developing partnerships, that talks about getting into the culture, finding the right group to work with, I think is key if you're going to get into the emerging market space. Great potential, but it's also a completely different level of risk and cost.
That's a good point. It's a very different cost structure. Emerging markets are much more expensive. They're still coming up the curve there for sure. But what's number 5? Well,
number 5 gets to be, okay, all of that looks great, but now what's my competitive advantage? What's your secret sauce? I'll use what is, your barriers to entry? You're going to be successful, but are you going to be able to keep other people from getting into the market? Do you have a patent? Is it hard to replicate? Is it something that you're bringing that somebody else can't bring? And, so I think that's one of the things that, again, when you're looking at establishing value, you're putting money into a company, you're investing in it, you want to see the growth, everything's, going great, and then all of a sudden, you've got competitor XYZ that comes in, starts taking market share, lower price, and all of a sudden, your value starts decreasing. So what is your barrier to entry? What makes your product, such that you're going to have a competitive advantage, at least for a period of time? Again, we see this in healthcare all the time, right? Somebody's got a product, and this product is good for a certain period of time, 8, 9 years, whatever it is. And then, the patent runs out, it gets to be a generic drug, and things change. And so, that's probably a great example of taking the value, you ride it as long as you can, but then once it gets to be a generic drug, then all of a sudden everybody's in the market and the price for that product comes down. So, again, that's just something you want to look at. What keeps somebody else out of the business? How can you keep your market share, for the longest period of time as you can?
Well, that's a good point. How sustainable is that competitive advantage is always a key question as well. But what's number 6?
Well, this is the last 2 I put down here, Hall. These are the ones that maybe wouldn't show up on everybody's list of criteria for investment, but these are the 2 that I've added, and it's probably I've just added since my time on the last 5 years of being part of the Baylor Angel Network, and quite frankly, it's been a significant learning opportunity for me. I've learned, so much. I was in the Fortune 500 business, you might say, working with large-scale companies, but to actually get into, the angel investing group looking at startup companies and entrepreneurs, and how do you evaluate deals, and what are the criteria that you use? We've already talked about some of them. Then it gets to be just a personal profile, and I'll use the example. I've got my last two. One is I just talk about what is your personal risk profile. I'll use the simple example is if you've got two companies, one is pre-revenue, but one's post-revenue. Which one are you going to pick? Well, let's talk about that a second. Pre-revenue, you're looking at higher risk, but also a much higher return up front. So it's you're putting your dollars in, and basically you're looking for that idea to basically get cultivated, for that product to get to the market so that you can start generating the revenues, and your risk profile is much higher. But for that higher risk profile, you ought to be getting a much higher return, assuming the product is successful. Post-revenue is, again, that's a different risk profile because now you've got a product out there, it's hit the streets, you've got revenue, and typically what we're talking about now is a company that's going to go through a growth scenario. And so what you could be saying is they're looking for additional capital that's really growth capital. That's what you're hoping is that this is really going to catapult the company to a much higher level of revenues, profitability, you're driving value on that side. Now, that is going to be a lower risk than the pre-revenue. And so I just think each individual has to kind of say, okay, I'm in this pool or I'm in that pool. I was with an investment session here a while back, and we were on the panel, and one of the other Baylor Angel Networks, he and I were on the panel together. We were discussing options or talking about pre-revenue, post-revenue, and he fell on the pre-revenue side. And that's, he is a creator, entrepreneur. I felt more on the post-revenue side, to where I'm probably willing to do more deals from the standpoint of looking at lower risk, but maybe drive more dollars into that side of it than I would on pre-revenue. But this is just a personal issue. There is no right, no wrong, but I do think individuals need to kind of figure out which side of the fence they want to be on. And that's the easiest example for me when I talk about the risk profile was to talk about pre-revenue, post-revenue.
Well, there's a clear difference between risk and reward on those two scenarios. What's number 7?
Well, my last one is one that I probably have learned over time, Hall, because we've seen certain deals that have been presented to us in the, at Baylor, and we've gone through the whole deal, and then somebody starts talking about the cap table. My 7th criteria is, when I'm getting to the cap table, is I love a simple cap table, i.e. an ownership table. There are times when we get down to the end, everybody likes the deal, so maybe it's been through, they're looking for their second or third round of growth capital, and then they start talking about, well, here's how the ownership works of what we have today, and they start getting into various layers and overrides, etc., and it, quite frankly, it gets confusing, and it also gets concerning. And when I say concerning, it's, well, I'm going to put my money in, but what am I really buying? What percentage am I really getting? And Hall, you probably have seen more of these than I have, but it just makes it a lot easier, for me, the individual, the investor, if I can look at a deal, I see a cap table, and I'm looking, and I know what the pre-money valuation is. Okay, I'm going to agree to a price, and that's important also. Do I agree with the price as far as what they're doing pre-revenue? I'm putting my money in, and then post-revenue, we have a capitalization table, and so I know what my percentage ownership of the company is. That to me is simple, but it's so important. And when somebody gets to something that starts getting convoluted and I don't understand what I'm buying, I tend to back off.
So in an equity deal, they're setting pre-money valuations, and the valuation is set or known. What do you do about convertible notes where the valuation is not being set now but will be in the future? How do you treat those?
That's a great question as well. Convertible notes, it all gets down to what's the convertible price going to be. I personally don't like convertible notes only because I don't know at the end what price am I really buying the company at. And now, again, maybe this is a case of where I like to be more conservative, and so I'd love to know what the price is going to be. Now, what we are seeing nowadays, it makes it a little bit better when somebody says, okay, here's a convertible note, but to make you feel comfortable, I'm going to set a cap price of X, or I'm going to give you a 20%, 30% discount off of whatever the cap price is going to be. And those two things help me. But if it's just an open convertible note at some price, I really don't care for that, Hall.
Right. Valuation makes a big difference because you know what you're buying and what you're actually going to get. And some of these term sheets have, clawback provisions, or they've got redemption rights at very low numbers. And so there's gotchas in there where you think you may have it, but you could lose it later. And so having the term sheet makes a big difference as well. Good. Well, great. Well, just to recap for a moment, what I hear you saying, Ed, is you look for the management team first. That's great. That's always number one. And then number two, you look for the market. And number three, you look at the business model, how they make money. Number four, you look at how big the market is. Is it established or is it emerging? Number five, you look at the competitive advantage of the company, and is it sustainable? And number six, you look at the risk profile. Is the risk and the reward commensurate on those things? And number seven, you look at the cap table. Is the valuation known, and is it set so we know exactly what you're getting? So those are the seven major takeaways. Is there anything else you'd like to share about what you look for in these deals? If two deals made it all the way through all seven, what would be the final criteria to choose one or the other deal?
Oh, boy. If it got down to the final, I probably would go back to number one and say that I would have to make a decision based upon the management team and just look at those real close and then go to the management team and just determine which ones I like better.
I guess that's always the case is management team trumps all at the end of the day, and if it's a tiebreaker, it becomes a tiebreaker.
Management team trumps all. That is the ultimate, to me, that's the ultimate tiebreaker.
There you go. Well, very good, Ed. Well, thank you so much for sharing your experience here today. Appreciate your taking time, and looking forward to seeing you at the next Baylor Angel Network meeting. And with that, we'll go ahead and close it out for now.
Thank you, Hall. I appreciate it. We'll see you soon.
All right. Thanks.